Good morning and welcome to The Open here on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Time to get to some of the stories we're following in the BNN Bloomberg newsroom. Shares of Corcept Therapeutics are falling in the pre-market. The firm received a rejection from the Food and Drug Administration for its drug to treat hypertension secondary to hypercortisolism. The FDA has asked for additional evidence to support a favorable benefit-risk assessment. The rejection comes despite the American company meeting the primary endpoint in its trial. It's off nearly 38%. Gold and silver dropping on the last trading day of 2025. Both remain on track, though, for record annual performances. Gold has had its best year since 1979. Silver pretty much the same. The past weeks, though, have been marked with some volatility to end the historic year for the precious metals, particularly for gold. It's advanced more than 65%, but silver also up more than 140%, roughly 135%. Elevated central bank buying and the U.S. Federal Reserve's easing cycle have boosted prices. Elon Musk's xAI is planning an expansion of its massive data center complex in Memphis, Tennessee. They're going to put up a third building. The purchase brings its AI computing capacity to almost 2 gigawatts. 1 gigawatt is enough to power about 750,000 homes, really closing in essentially on the size of Toronto. Musk has already built one data center known as Colossus. He's currently building a second one nearby. That's called Colossus 2. And the new building will adjoin the Colossus 2 facility. And taking a look at the markets, good to see some green there after a rough few days. Right now, they've swung a little bit into the positive territory, mostly a wash for the Dow and the S&P 500. It's going to be a slow day today. NASDAQ is showing a 0.15% increase as we look to end the year on a shortened trading day. The TSX, let's see what it can do today after another day of losses. Put it down below, well below 31,900. It's at 31,866. It was off by 0.1. No Santa Claus rally, it looks like. Moving over to oil, and it is going to end the year soft. WTI was up, but it's still for the year. You can see it's up by more than 17%, almost 18%. And we were just talking about gold and silver, and you can see gold is off again by 0.76, 0.77% right now, but still up for the year at 66% right now. And silver having an even better run. It's up about 135, 140%, depending on what it does today. And the Canadian dollar, hardly worth mentioning. It's off ever so slightly. Looks like it'll close the year, though, up about 4.78%, roughly. And Bitcoin, trying to end another little sluggish spin it's had. You can see after that peak at 123,000 around there, it is off and off for the year by about 3.25%. It's up for today. Well, today is New Year's Eve, December 31st, and it marks the end of the 2025 trading year. To look back on the TSX, we were joined earlier by our guest co-host on the street, Ernest Wong, head of research at Baskin Wealth Management.
To frame the TSX properly in context, we have to remember where we started at the beginning of the year. Entering 2025, there were concerns about the Canadian economy, about geopolitical issues where Donald Trump is calling Canada the 51st state. Mm-hmm. Immigration was too high. There were concerns about mortgages renewing. And I think over the course of 2025, these headwinds faded as the rhetoric around trade has come down, interest rates have come down, the consumer has remained remarkably resilient, and I think that's reflected in the performance of the TSX.
Which was a third year of double-digit gains, and up around, we were talking about this, up around 29% heading into today. I mean, it's outperformed most of all the U.S. Stock exchanges, right?
And what's surprising about the TSX performance is that obviously gold and materials had an outstanding year, but it was really strong across the board. Almost every sector, except for healthcare, which is very small anyways, was up, and most of them double digits, including banks, financials, consumer, certainly information technology. They were all very strong performers for even energy, which where oil prices were down, was up, I think, 11% year to date. So very strong performance across the board for the TSX.
What was the most surprising one to you then, of those sectors?
I think consumer was certainly the one that was surprising to me, because looking ahead to 2026, people are still renewing their mortgages at higher rates from the ones that they underwrote in the COVID period. And so that has remained a headwind on consumer spending. And the fact that companies like Loblaws or Canadian Tire, they're posting surprisingly strong results, I think that speaks to the strength of the economy.
And with the dip we saw in April, and that was a huge dip, if we didn't have that, how do you think the markets would have done? Would we be in a similar situation or even higher?
I think it's just part of how the markets work, where due to the fears about trade, especially for Canada, and the fact that these worries have eased as we went on throughout the year, they have contributed to the rally. Now, looking ahead to 2026, we do have I think our Prime Minister and President Trump are meeting to renegotiate, to discuss whether they want to renegotiate CUSMA. I think it's in the interests of both countries to continue to work together. And I think but on the flip side, we still have the mortgage renewal issue. Productivity is still not great. Immigration is certainly slowing down. And so I think those are all the factors going into the performance for 2026.
Which do you think is the biggest potential headwind? I mean, CUSMA, if we get a deal, that's a tailwind.
Yes.
But if we don't, it's a definite headwind. Is that the biggest concern then going into 2026?
I think so, because the main impact for CUSMA and trade overall is not necessarily even the actual tariffs that are placed on, but the uncertainty that is happening in the economy, where businesses are not investing in plant expansions. They're not hiring more people until they have more clarity around what happens to trade. So I think that is the headline that is going to dominate 2026 for Canada as well.
And I'm going to put your crystal ball in front of you. What's the feeling you have? I mean, we've had Trump saying, well, maybe we don't need CUSMA at all and we'll throw it out. Is that a reality, though? Or is he listening? Do you feel like he's listening to people behind the scenes that are going, no, we need this?
No, I think that clearly Canada needs the U.S. as a trading partner. 2/3 of Canada's, or even higher of Canada's exports go to the U.S. But I think let's not forget that a large portion of what Canada exports to the U.S. is needed by the U.S. So a lot of regions in the U.S. rely on Canadian crude. They have no other sources, no other pipelines. They have no way to get Canadian crude. A lot of the alcohol suppliers in the U.S. are certainly struggling because of the tariffs that Canada is placing on the alcohol industry. I think that other goods like zinc and potash and aluminum, Canada is a major exporter to the U.S. that the economy in the U.S. requires to make goods. So I think it is in the interest of the United States to be a little bit more gentle towards Canada going forward as well.
And just quickly before we'll go to a break, but the TSX, which sectors do you think are best set up to kind of weather what may be ahead in 2026? And are we looking at another year like we saw this year with a 29% return?
I think that certainly what we're excited for about the TSX is that there are just a lot of good quality companies. To avoid your question slightly, is that there's plenty of very, very high quality companies trading on the TSX. These are kind of global, diversified leaders They do a great job in making acquisitions and consolidating their field. They're trading at relatively low valuations compared to their history, and we'll talk about some of them later, I'm sure. And those are the ones that we're excited for going forward.
And that was Ernest Wong, head of research at Baskin Wealth Management. Coming up, we're continuing our look back on 2025. Stay with us. An influx of millions of immigrants welcomed into Canada in recent years has been blamed for the rising cost of rent to overstretched public services. The door has slowly been closed on many foreigners entering the country, with the new federal government calling the Trudeau-era policy unsustainable. CTV's Adrian Gobiro with the backlash and the consequences that have the country charting a new course.
Canada's once ambitious immigration targets have led to a hard landing.
We're reducing the numbers of immigrants that will come to Canada for the next 3 years.
The former Trudeau government acknowledging they made some mistakes. In 2022, Canada welcomed more than 405,000 newcomers, with plans for 465,000 permanent residents in 2023, 485,000 in 2024, and 500,000 in 2025.
Did we take too long to adjust? I think there's some responsibility there.
The government eventually reworked its plans to decrease its target to 395,000 permanent residents this year, while lowering that number even more over the next 2 years. The about face set in motion a seismic shift in Canada's immigration policy that has played out over the last 12 months.
We've got this huge influx of people on Canadian soil expecting permanent residence who won't get it.
The number of international student visas were slashed this year, leading to college and university program cancellations and sweeping job cuts.
We're seeing one of the largest mass layoffs in Ontario's history.
A cap on international student permits that began in 2024 and into 2025 will see a further reduction in 2026. As Frosh Weeks rolled onto campus this year, international students were taking note.
A lot of international students dream of studying abroad. I have a sister. She might be wanting to study abroad, and caps like this are affecting her.
It's a concern shared by Canadian university executives.
60% decrease in the number of new students approved to attend Canadian universities in the first quarter of this year. They, in fact, help pay for more spots for Canadian-born students to attend university because international students pay higher tuition fees.
Ottawa put a limit on foreign students in part to help ease the pressure on the cost of rental housing while trying to reduce the burden on hospitals and other public infrastructure and social services. Citizenship Canada says its aim is also to create a pipeline of international student graduates whose skills match the country's long-term economic and labor needs. Adding eligible fields include healthcare, social services, education, and the trades. In his first news conference in May following the federal election, newly minted Prime Minister Mark Carney pulled in the reins on immigration even tighter.
We will return our immigration to sustainable levels by capping the total number of temporary workers.
That led to an outcry from some labor groups, even a lawsuit against the federal government, filed by a conglomerate of Quebec-based businesses who claim they're losing money and now unable to fill vacant job postings.
These companies either have to slow down production, refuse contracts, and in certain cases, they will even close down certain shifts. We can think of weekend shifts, night shifts, because we can't find the workers that we need.
The Carney government has pressed on, promising to cap the level of foreign workers and international students by less than 5% of the country's population. The 2025 federal budget highlighted that in 2018, 3.3% of Canada's population were temporary residents. By 2024, that number had more than doubled to 7.5%, an unprecedented rate of growth that put pressure on housing supply, the healthcare system, and schools. Canada's new government recognizes that this system is no longer sustainable.
We will work to attract the best talent in the world to build our economy.
The recent spike in the country's population has in part resulted in nearly zero GDP per capita growth over the last number of years, meaning the slice of the economic pie is getting smaller for each Canadian. A country built on the back of immigration has now recalibrated as it charts a new course into an uncertain economic future. Adrian Gobiro, CTV News, Toronto.
The end of 2025 also marks the end of an era at Berkshire Hathaway. Legendary investor Warren Buffett is retiring today, and we'll look back on his impact and legacy with Ernest Wong. Legendary investor Warren Buffett, the CEO of Berkshire Hathaway, is retiring as CEO today. For more on how the Oracle of Omaha changed investing forever and what's next for the company he built, our colleagues at Bloomberg dove deeper.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway.
Greg Abel led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic.
He won't be writing the annual letter next February. This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
And for more on Warren Buffett's legacy, we talked to Ernest Wong, head of research at Bascom Wealth Management.
It's a legend in every sense of the word, where Berkshire Hathaway started it he made the acquisition in 1965, has compounded returns at 20% per year for about, I think, 50 years, if my math is 60 years.
Yeah,
my math is correct.
Yep.
Which is compared to the S&P 500, which has done about 10% throughout that period. And I think what is remarkable about that is just the longevity and the consistency of the returns, because every year there's good stock pickers who have good or bad performance, but to do this for 60 years, I think that there just hasn't been anybody else who has done this for that long.
And with everybody else probably looking and going, okay, what's Warren doing? And we'll copy that. And yet they don't see the same, they don't manage to keep track on what he's doing. That's incredible.
No, I think what people often forget about Buffett is that he was the original innovator for a lot of the financial concepts that we have today. So he created the first hedge fund. He came up with the idea of using insurance float to invest in stocks and make investments to increase returns that way. And he was the one who really popularized the idea of buying and holding great companies, which so many investors do today. So I think that all of us owe a debt of gratitude to Warren Buffett, not just for the returns he's generated for shareholders, but also for the lessons that he has taught everybody over time.
And what have those three things done? Like what's been the most important, you think, and what kind of an impact has each one had on it? Because you are a fan of him.
Yes. No, so I think at Bascom Wealth Management, I think we certainly have tried to structure our firm and adopt many of Warren Buffett's key investing principles. We only really try to invest in really high-quality businesses that have asset-like characteristics that can compound capital at high rates for the long term. We try to minimize turnover, so we're not trading in and out of stocks. We really focus on strong fundamental research for the names that we own. And all of this really comes from Warren Buffett, where he was the first person to have done these things. And so I don't think what we would be doing would be possible without him really having taught all those lessons along the way.
And is it his research? What is it about him that has, because he's managed to stay ahead of everybody else as well? I mean, nobody else has seen that 20% return for 60 years.
No, and I think that's the incredible part, because when he first started, it was a completely different era for the financial markets, where there were no Bloomberg terminals. You cannot access company filings on the internet. Like, he was picking up the phone and calling executives and doing research kind of the old-fashioned scuttlebutt way.
Yeah.
But as the markets have evolved, he managed to keep up and evolve his own investment process to catch up with, to evolve with the times. And so I think one of the remarkable investments that he's made is his Apple investment, which he made in, I think it's 2015, at the age that he did it at. And given what we know about his investment philosophy, it was a shift towards a less proven type of business than he had done in the past. And so I think that reflects a remarkable amount of mental flexibility on the part of Buffett.
And it just shows you can have all the information in the world. In the end, though, it almost comes down to intuition, doesn't it?
It really does. It comes down to having the experience, which obviously Buffett has had. It comes down to the fundamental work that you've done over the years to build up knowledge to prepare you for what is coming ahead.
And now Greg Abel's replacing him, but of course Buffett's still involved. How do you think that'll unfold?
So Buffett has publicly said that he will no longer appear at the annual meeting. He's no longer going to be writing shareholder letters to shareholders. Mm-hmm. But he will remain as the chairman, providing guidance to the incoming CEO, Greg Abel, who we think he's going to do a terrific job. He's already made some changes to the business, has a new CEO of Geico, appointed some new division heads, and brought in somebody that he knew from the utilities business to be his CFO. Mm-hmm. So I think 2025 was a year where Berkshire Hathaway is transitioning to this new era, and we hope to see more of that going forward.
That was Ernest Wong, head of research at Baskin Wealth Management. Opening bells are coming up next. All right, the last opening bells of 2025, which was shaping up to be a good year, although maybe ending up a little bit down, but still up overall for the year. At the NASDAQ, it's the Times Square Alliance, started about 35 years ago to celebrate all things at Times Square, of course, where the big ball drop will happen tonight at midnight. They are ringing the opening bell there. At the New York Stock Exchange, it's the Downtown Alliance for New York. They're promoting all things down in the lower Manhattan area, and the Honorable Christopher Marte was the one ringing the bell there. It is time now for the first 15. This is BNN Bloomberg. Trading is just getting underway. Let's check in on the equity markets and see what's unfolding there. First up, you can see the TSX continuing its negative ways, maybe a fourth day of losses, although minor right now. And looking on the other side, it's going to be a slow day anyways. Looking the other side of the border, the S&P 500, pretty much a wash. Same with the NASDAQ right now. We'll see what happens as we end the year, but they will all end in positive territory overall. A Bloomberg investigation found China is building a small city of AI data centers in a remote desert and looking to buy 115,000 of NVIDIA's best chips to power them despite a U.S. export ban. This Bloomberg doc dives deeper. All right, we're having some technical difficulties with that, Doc, but we will get to it when we get that problem fixed. For now, we're just going to have a bit of a break. We'll be back in a minute. Apple has long led Silicon Valley in tech, but in the world of AI, it's fallen way behind. Continued missteps could arguably threaten the iPhone's dominance. What went wrong, and can Apple catch up? This Bloomberg doc dove deeper.
We've all been there.
Siri, what's the name of the guy I had a meeting with a couple of months ago at Cafe Grinnell?
You met Zach Wingate at Cafe Grinnell.
Zach!
Actor Bella Ramsey was bailed out by a new version of Apple's Siri that was meant to be available for all.
That feature still has not been released. It's originally supposed to come out April, May of 2025, but now it's on track for spring 2026.
Apple took down the ad and is facing a lawsuit over the delay. But the disconnect exposed a deeper issue. The company was losing ground in the AI race.
They totally missed the boat. There was indecision. There was lack of concern that this could become a real thing.
This is a story about how hard it can be to stay on top.
AI is something that wasn't in their DNA.
Continued failure doesn't just hurt Siri. It could threaten the iPhone's dominance. The product line accounts for more than half of Apple's revenue. So missteps with what's become its most noticeable missing features could be devastating.
AI has the ability to be a make or break moment for the company.
Apple has always been about good design and accessibility.
Historically tends to wait until the technology has been improved by others, then it will perfect it with its own design and some of its own features, and then it will show it to people. And it's done that really well.
They knocked it out of the park with multi-touch, the very core of the iPad. They completely destroyed the competition with their chips. But with AI, they seem pretty far away from really nailing the user experience and the core tech.
Nowhere is this more apparent than with Siri, its character in a play also starring Amazon's Alexa, Google Assistant, and for a while there, Microsoft's Cortana. Poor Cortana. But here's the thing. Apple didn't create Siri. It bought it.
Siri.
Back in 2011, the little-known app gave Apple a head start.
There was really nothing like it on the market at the time.
What is the weather like today?
Here's the forecast for today.
People had been clamoring for some kind of assistant software, and it looked like they had something very cutting edge.
Now this race is far from over.
But its early lead didn't last. Within a few years, those other players hit the stage, and they felt far more advanced.
They came out with a product 4 years after Siri, but it quickly felt that they were 4 years ahead of Siri.
Again, Apple threw some money at this burgeoning AI problem. It poached one of Google's top AI executives, John Giannandrea.
He quickly took over Siri and all the AI initiatives. They brought everything under one roof, and at that point, people were very excited. Not only had Apple taken a prized AI mind from its biggest competitor at the time, but now they felt like they can push all their eggs into the AI basket.
Giannandrea's team tried building a lighter, faster Siri, but the project was ultimately scrapped. Meanwhile, rivals were racing ahead to develop large language models, a foundation of generative AI. For Apple, things were about to go from bad to, "Hey Siri, what's a good word to finish this sentence?"
It's called ChatGPT, the AI language tool that is fascinating and frightening people around the world.
It makes it almost like you're talking to a person.
ChatGPT changed really everything for the world, the industry.
People were experimenting with similar technology to what OpenAI was using, but they hadn't put it together in quite the same way and released it to consumers. Other companies quickly realized, hey, they've really caught on to something here, something that people seem to want.
Craig Federighi, Apple's software engineering chief, he realized this is a game changer. So him and other executives sat down, met with OpenAI, met with Anthropic to get a crash course on LLMs and models. And so Federighi immediately put the software engineering group to work to develop a new system-wide approach to AI.
It's showtime.
Everything converged at the Worldwide Developers Conference in June 2024, where the company revealed Apple Intelligence.
Personal intelligence system that makes your most personal products even more useful and delightful.
came out and they showed all sorts of features that seemed impressive. One was for summarizing text.
Writing tools can rewrite, proofread, and summarize text for you.
Summarizing notifications.
Make a Genmoji.
They created something called Genmojis, which basically allows you to type in some text and create any type of emoji based on the text input. They also came up with features like notification prioritization. And Apple called this AI for the rest of us.
We are introducing the industry milestone product, Macintosh.
It was a callback to when they introduced the Mac, and they call that the computer for the rest of us.
But Apple Intelligence was a dud out of the gate.
They announced the iPhone 16 that September, and they called it the first iPhone built from the ground up for Apple Intelligence. Truth was a little different. Apple Intelligence didn't launch until a month and a half after the iPhone 16. But the biggest drawback were the AI Siri features.
You know, the ones still missing from the phone.
Apple Intelligence is a huge black eye for Apple. It's one of the biggest issues the company has had in its history.
Investors have taken note.
AI shortcomings are one reason why Apple's share price has performed weakly this year among the so-called Magnificent Seven tech giants.
In a vacuum, the Siri features may not seem super important. The reality is that we're moving into an AI device ecosystem, a world of products driven by machine learning and artificial intelligence. Meta's working on this, Google's working on this, even Apple's former design chief, Johnny Ive, is working on this.
Apple has several projects to rescue Siri: a rebuilt engine, an AI web search tool, a refreshed visual interface, and a more conversational assistant.
They want to make Siri an always-on life co-pilot that can get things done on your behalf and is something you can trust.
The big element under discussion is how much the company will rely on an outside partner versus its foundation model's team. What the heck is a foundation model, you might ask? Good question. Essentially, it's a grand jack-of-all-trades software that powers an AI tool. OpenAI's GPT-5, for instance, is the foundation model you can throw anything at via the product ChatGPT. It's the engine of the family car. And for Apple, this technology could form the core of a new, more capable Siri.
Apple has talked with Google, with OpenAI, with Anthropic, about replacing their foundation models with the underpinnings from those third parties. If Apple's able to do that, you're looking at a really potentially great product. Marrying Apple's user interface design with the hot core technology, that would go a long way for consumers. Because consumers, for the most part, don't really understand or care, quite frankly, who made the AI technology, and Apple just wants to sell cool products.
What they're hitting up against here is with generative AI, it's so expensive and so time-consuming and difficult to build this kind of thing yourself.
Ironically, some of the company's notable practices have hindered its own progress. First, spending. Despite having a lot of cash on hand, Apple doesn't do it lightly.
In the AI world, you're investing tens of billions of dollars a quarter, depending on what your company is, without even knowing if you're going to get a payoff. Apple doesn't invest large sums of money without knowing there's going to be a gigantic payoff.
This chart reflects the trend. Amazon, Google, Microsoft, and Meta are pouring billions into chips and data centers to power their AI models and support a business model of providing AI services to others. Apple's expenditures are far less, in part because it's only ever focused on building for itself.
With Apple Intelligence, powerful intelligence goes hand in hand with powerful privacy.
The company's stance on privacy also creates limits. It's championed on-device AI, processing much of your data locally to keep things private. But the iPhone's processing power only allows for simple features like summarizing an email. For more advanced requests, Apple turns to its own so-called private cloud compute servers, which use its own model and chips. Or on occasion, ChatGPT.
Take a look at how many iPhones it sold, 3 billion. They could have had access to so much search data, how people are using their phones, what apps they're using, but they really haven't used a lot of that to do training.
That same caution extends to its product development.
When Apple wants to develop a product, it does its research and it sits down to build it, and it knows exactly what it's going to build and how it's going to get there. AI is more of a universe where you're figuring out things as you go along.
In the past, where you might release a new product or do a software update once a year, perhaps twice a year, this seems to be like a constant churn, and it's really hard to keep up, even if you are a large company with a ton of money.
On top of this all, competitors are trying to lure top talent in the field, much like Apple did a few years back.
Meta and OpenAI are throwing large sums of money at Apple's foundation models engineers to get them to jump ship. In one case, one leader of Apple's foundation models team, Meta offered him a pay package over several years worth well north of $200 million.
In tech, you might be paid a lot as an engineer, but that would tend to be in like the hundreds of thousands of dollars, perhaps. This is just pushing things into a whole new stratosphere.
Good morning. Welcome to Apple Park.
At the iPhone 17 launch event in September, Apple had little to say about AI.
Design has always been fundamental to who we are and what we do.
But behind closed doors, Cook has described the AI revolution as big or bigger as the internet and smartphones, and told staff succeeding is, quote, ours to grab. Alongside a new Siri, the company is developing a bunch of products to help it catch up.
We saw this for many decades. Nokia was at the very top of the phone industry. Apple came out with a much better mousetrap. BlackBerry was at the top of the industry. Apple came out with a better mousetrap. They are going to be in danger of the next Apple being created if they don't get their act together soon with some serious acquisitions, changes, and partnerships.
We'll have more coming up here on BNN Bloomberg after the break. Canadian VC firms are boosting female and visible minority representation on their investment committees, but retention remains a challenge. Is the momentum strong enough to sustain a truly inclusive and impact-focused future in VC? To discuss their 2025 report, we were joined earlier by Emily Thiessen, board member and head of community at Canadian Women in Venture Capital.
A lot of new women are starting to enter the workforce in VC here in Canada. However, we see pay gaps closing, but not necessarily at that partner level. Our research this year showed that there's still about a 25% pay gap for female partners in Canadian women, or in Canadian venture capital funds, And so that's something that we're confident is going to change, but something that we're also watching really closely.
Okay, I just want to, I just got a question coming up, but I just want to ask a follow-up on this. What's keeping that separation? That's a huge gap.
Yeah, and that's transparently something we don't have an answer to and something that we're going to keep watching. We know at the partner level, there's a lot of different aspects to their compensation, from carry to ownership. And so what comes with that is a lot more negotiation dynamics at play. However, we feel like with this report that we publish, we're going to equip both men and women with the resources that they know to be what their pay should be and use that when it comes to negotiating their salaries.
Okay, so despite progress at the top, I think the report notes high departures among women in VC. So why are so many leaving, and what do you think needs to change?
Yeah, and that's something that really shocked us this year in our survey and in our data. We asked a lot of respondents, why would you want to leave the industry? And the number one reported reason was lack of growth opportunities. And so double clicking on that, we know that VC firms, there's flat hierarchies. It's hard to necessarily kind of grow year over year. So what we're doing is we're working with funds, communicating to them that they need to show that there are career progression tracks within their funds in order to retain their top talent.
And what are some of the differences that might be between men and women when it comes to the growth and the pipeline to move up?
So we don't necessarily have a good answer in terms of why women would progress necessarily than men. And we actually don't necessarily see there to be a big gap in that. Year over year, we see promotions across all genders, across all ethnicities within funds. And that's something that, although is a great progression, we do see that there is eventually a ceiling into getting into more senior level roles.
So what about compensation? Do you think that women are catching up on compensation and the carried interest portion as well?
100%, and that's something that this year's report showed, especially at the junior levels. We see there to be the compensation gap really narrowing and closing. But as I said earlier, where that compensation gap still exists is at that partner level, and it's something that we're going to continue to watch year over year.
All right, and let's talk a little bit about visible minorities. We're seeing improvement in representation there as well. What are those numbers looking like?
Yeah, so that's something that year over year, again, we're seeing more and more people enter into the workforce in VC. As we see a third of the industry going to be turning over, we're placing big bets that more diversity is going to come in as more funds hire and attract this type of talent. And so it's something that we're planning to actually measure and report on next year in terms of actually seeing how many more diverse people are entering into the Canadian VC industry.
And if we revisit this report in 5 years, what progress do you hope we've accomplished during that time?
Yeah, great question. There's a few things. So one, to really see those pay gaps narrowing, it's something that we're watching. The second thing we really want to see is more retention within the industry. So funds implementing different policies or different sort of roadmaps for growth within their funds. And the other thing too is just more equitable overall compensation packages across benefits, across parental leave. It's something that we want to see more progress made towards as well.
And do you have any concerns about DEI policies disappearing? I mean, just because of the atmosphere and some of the attitude, especially south of the border. Are you concerns about those disappearing?
Not necessarily. For us, it's all really about what is the talent. And we're seeing more women, more diverse people really coming into this workforce and actually bringing a lot to the table, where they're bringing their different aspects of how to essentially work with founders, how to investigate different deals. And so because of that, we think more and more people are going to be coming to the table and competing for these spots at these funds, and they're going to deserve it too.
And is it important that firms care about this?
Absolutely. And we see that through studies done in the US, studies done here in Canada, that having diverse people on your investment committee can actually lead to greater returns. And so that's something that we've seen that trend play out in the US, and we're going to see that play out here in Canada as well.
All right. Just want to touch on one more thing. ESG, there's some mixed reviews right now.
Yeah, when it comes to ESG, so there's a lot of different sort of policies that we're seeing be implemented at funds. Where that pressure is coming from, though, is at the LP level. And so for us, it's something that we're going to also watch and monitor to see. However, when it comes to actually implementing these policies, it's going to be all on the partners, but we're confident that the partners are really going to start to prioritize that in the years to come.
Emily Thiessen is board member and head of community at Canadian Women in Venture Capital. Well, yesterday on Market Call, we were joined by Mike Philbrick. He is the CEO of Resolve Asset Management. He was covering exchange-traded funds. His top picks were Vanguard Canadian Government Bond Index ETF, VGF on the TSX, VGV, on the TSX, iShares S&P on the TSX, Capped Energy Index ETF, XEG on the TSX, Invesco Solar ETF, that's TAN on the New York Stock Exchange. And today on the show, we have Brendan Caldwell. He is president and CEO of Caldwell Investment Management, and we'll be taking your questions on North American large caps. Okay, let's see how the markets are doing as we wrap up the year. Overall, it was a good year, but it's, oh, look, you got the TSX. It is back into the green again, ever so slightly, pretty much a wash after 3 days of losses. But overall, you can see for the year, it's up 29%. So what fueled that right now? Well, there's a few companies that fueled that. Here we go. We'll go into Energy Fuels, talking about how it is doing today. And you can see it is up about 3% right now as we move into 2026. And Next Gen Energy also seeing a nice bump today, up by 2.3%. Another year, up 32%, almost 33% for the year. And Strathcona Resources, again, they are all having good years. They're up 1.7%. It's off, though, for the year, Strathcona, but down about 3%. But Blackberry, another one that it's been around. We talk about it. Let's see how it's doing right now. It's up about 1% and still down, though, for the year. Cameco, as well as another one we want to take a look at that's leading the way. It's up by a little under 1%, up 71% for the year. Now, there are others, though, that are having off years, and let's take our off days, I should say. We can take a look at those quickly before we get on to some of the groups, see how they are doing. Arrow Copper down by 0.5. Oh, it's up now. Look at that. From when we first got the notes to when we get that instantaneous, but look at that. It's up for the year, 106%. H&R Real Estate Investment Trust, it was down, and it's down a little further now, 1.36%, but up 9% for the year. Hudbay Minerals, another one we want to check on. And you can see it's off by 0.4%. It's a very slow day. It's still up 136% for the year. And what are we moving to next? Ivanhoe Mines is up next, and you can see it's up down by 0.76%, off for the year. We're going to go to oil now, and it had a rough year as well, down 17% for WTI, and up slightly today, but still below that 60 mark. And coming up, we're going to talk markets and fine-tuning on our AI radar. That's after the break. Welcome to the second hour of The Open. I'm Roger Peterson. Thank you very much for joining us. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Gold and silver are falling today after recovering on Tuesday. The metals have seen exceptional volatility in post-holiday trading. The changes have prompted exchange operator CME to raise margin requirements twice now. On the upside, both remain on track for their best years since 1979. Demand has been strong amid mounting geopolitical risks and interest rate cuts by the U.S. Federal Reserve. Oil is headed for its steepest annual loss since the start of the pandemic. Global oil markets have been oversupplied this year. Multiple factors, including OPEC Plus raising its output and the United States pumping at record levels. Now, oil production exceeded consumption in 2025 by about a little more than 2 million barrels a day, and this surplus is expected to grow in 2026. Elon Musk's xAI is planning an expansion of its massive data center complex in Memphis, Tennessee. They're going to add a third building. The purchase brings its AI computing capacity to almost 2 gigawatts. 1 gigawatt is enough to power about 750,000 homes. Musk has already built one data center known as Colossus, and he's building a second one nearby called Colossus 2. And looking at the markets, not surprising, very soft day today. 3 days of losses for the TSX, but now we're up. If you want to call it that, don't expect much from today. Still up 29% for the year. South of the border, all in the red right now. That little year-end slump rather than a Santa Claus rally continues. You can see they're all off by about 0.2% right now. And oil up right now, but it's going to end the year quite off, really 18% for the year, and it probably might not get better to start the year. And let's see what gold's doing. You can see a little bit more there that it's off again today, but still, again, up for the year. It's been a bit of a roller coaster the last few weeks, but 4,300, 4,354 right now, and up 66%, more than that for the year. Silver, similar, it's up about 130%. And the Canadian dollar, little bit of a drop today, but it will still end the year up about 4.72% right now. Our next guest thinks AI is here to stay, a bubble or not. He says the conversation around AI should evolve into more selective AI stock choices instead of whether we're in a bubble or not. And here to talk about that and other aspects of the market is Hans Albrecht, CEO of Gamma Option Solutions. Hans, thank you very much for joining us.
Good morning, Roger. Thanks for having me.
So we don't want to talk about a bubble. Is it a bubble, but is it something that's going to pass, or should we be a little concerned about it? What are your thoughts on where we're at with AI?
Well, the word bubble is always a tricky one, right? So there's bubble from a fundamental standpoint, which is, AI is happening. We can deny it. It is happening. It is going forward. And we are, in my view, we are very, very early innings in the inference phase. In the build out phase, we're probably third or fourth inning. In the inference phase, which is that utility phase that I think the market sort of underestimated this year. So it didn't realize, as we looked at, remember earlier in the year, they were worried, are they spending too, are people spending too much? Where's the ROI on all this build out, all these data centers and chips that they're buying? Eventually we moved into that inference phase, which is really the way that it starts to proliferate throughout the economy. So from that perspective, Roger, this is just getting going. There aren't that many enterprises that have adopted AI tools, whether agentic or otherwise, and that has a heck of a lot more room. And I think 2026 is going to be the big year for us seeing this move into the rest of the economy. So that is really the story of the bubble from the perspective of, is this happening? There is no bubble there. Now, of course, you and I watch markets and stocks all the time, and at times stocks can get a little ahead of themselves. And we did see that a little bit in the last few months in the sort of high beta areas, the nuclear, the quantum, those sort of, the way that I see it is I sort of categorize it as, what have you done for me lately, which versus what are you going to do for me in years from now? So it's very much a show me now market. We have less tolerance for those crazy high beta names at the moment, but I think that comes back because, as I said, I think we're just getting going on this stuff.
And now within AI, you say you have to look beyond Mag 7. Where are you looking?
Well, I think there's a big story of broadening, so that I get excited about the other 490 stocks as opposed to the sort of the 10 that everybody knows. So I think one of the challenges for investors this year is going to be push your sort of comfort zone out into the rest of the world. There's some beautiful things happening out there, and areas like, I've been calling Goldman Sachs and some of the banking stocks in particular AI names, sort of AI adjacent names, because they're not pure AI, but they're a great example of an area where you're going to see efficiencies, productivity gains, the usage that, early in the year, the CEO of Goldman Sachs came out and said, we can do an IPO in like 5% of the time and for a fraction of the cost that we used to be able to. I'm going to guess that when they do these things, they're not going to be, passing on those savings to the customers. They're going to say, thank you very much. So that's an example of where there's a lot of room to use AI to improve many of your processes. And what does that mean? That goes to the bottom line. That is going to be an increase in profit margins, and we're going to see that across the board. So I like those other areas. I like healthcare. It's going to benefit greatly from AI. I love banking, and really you can expand that. This could be a 3-hour conversation as the rest of the world starts to benefit from some of these things, I think, this year and in following years.
Now, you mentioned Goldman. Are there banks and in healthcare that companies are clearly ahead of the curve that you're seeing?
Yeah, I mean, Goldman, JPM, I prefer those sort of big money center banks. The investment banks kind of, I'm not so sure, because of course there's always this question, we may be getting ahead of ourselves, but this whole employment question, which I think is going to kind of hang over the market to some extent. It's going to sort of sit there in the background, like a sort of that, that guy who came to your party and everyone's wondering, did he invite him? Well, he's there, and he's going to be suggesting that, listen, there's going to be a weakening in employment that I think is going to persist. And so that is going to have a little bit of an impact on how we see things going forward, because this isn't going to be, my dad's economy where productivity increases with an increase in employment. It's going to be very much kind of flatlining. Companies have basically said they're not hiring. So I think it gets a little bit tricky. The low-hanging fruit is going to be in finance. You can very easily do things with AI. And there are other areas, robotics and things like that, that are going to be a little trickier because of the physical aspect of that. But in healthcare, I mean, healthcare is a tricky one. I kind of like to go XLV and, things like that, just kind of keep it broad. But I think the Pfizers of the world are going to do well. And I think in bio, we're going to see some really explosive type results coming out. And that's kind of exciting.
Okay, and within AI, some names that have come up: Palantir, Snowflake, Datadog. Your thoughts on those ones? What do you like about them?
Yeah, so what I like to do is I like to think of, well, where is the disruption going to happen, and where is the sort of need to have versus nice to have? And so in the semiconductors area, I've been a little bit sort of neutral on NVIDIA, and since then I've said, well, listen, there's some names like Micron where I think you can kind of step in there, and it's up quite a bit since I started covering it, but because there is a real shortage of memory. We need more memory. The market got it wrong. We need tons and tons and tons of memory as we expand into this inference phase, into the sort of VLM phase, as opposed to the LLM. That's sort of more video use. That's everything around us, monitoring and using AI. So there's going to be this kind of idea of, are there shortages and things like that are going to continue to sort of play throughout that AI industry kind of outlook.
And moving on, we want to get a couple more things in before we run out of time. Gold, and everybody's talking gold, but silver too. I mean, silver, we're seeing some a little bit of friction right now, but gold and silver probably one of the big stories this year as well.
Very big story. And I think this is almost related to what we've been talking about on the AI side of things, which is, we've moved from the sort of moonshots, well, what could happen, what might happen, to, well, I can trust things that I can drop on my toe, right? I can drop copper on my toe, it's going to hurt gold, et cetera. So these are things that are very much a need right now. And it's real. This isn't, quantum may change the world at some point. This is very much, what do we need for this big infrastructure build out? And so I think gold, a little bit less so gold. Gold's probably a little bit more intertwined with policy uncertainty, debt, stimulus kinds of things, where there's uncertainty as to who's going to lead the Fed and that kind of thing. But from the perspective of silver and platinum, I mean, these are things we need, and copper as well. We need these things for this massive infrastructure super cycle, which is well underway. There's a lot of evidence that that's actually happening. So these are real supply problems, as opposed to things that kind of live in the ether that we kind of can look forward to some years down the line. These are problems that are happening now. The power problems, the grid enabler type commodities. We need tons and tons of copper, and it isn't easy to just start pulling that stuff out of the ground in larger quantities.
All right, we have to wrap it up there, but Hans, thank you very much for joining us. All the best for 2026.
Thanks, Roger. You too. All the best.
Hans Albrecht is CEO of Gamma Option Solutions. Coming up, Lindsay Biscaya hosts a roundtable with Andy Bell and Derek DeCote. We'll talk about the impact of tariffs on 2025. Stay with us.
Hi there, I'm Lindsay Biscaya, and joined with BNN Bloomberg's Andy Bell and Derek DeCluitt, executive editor at Bloomberg News Canada, for a look back at some of the big news stories, big news makers of the year. So we'll get started with the first one. Obviously, we can't really think about 2025 without thinking about trade, tariffs, the ongoing kind of trade dispute that Canada has with the U.S. So Derek, I guess I'll start with you. Obviously, many sectors hit hard by this. You don't want to compare one against another, but one of the industries really hit hard was the auto sector. What do you think happened throughout the year to that sector?
So in the middle of March, Donald Trump, in one of his famous Truth Social posts, said he would like to permanently shut down the Canadian auto industry. It was part of the dispute that he was having with the Ontario Premier, and Justin Trudeau at the time was just on his way out as Prime Minister. And this is like one of the big stories to watch in the trade file for next year, because the auto sector is different than everything else. They can't, the aluminum business is not moving out of Quebec. It's dependent on cheap hydro. The trees are not moving out of British Columbia, and the softwood lumber part is difficult to solve. But these are industries where Canada has an inherent advantage. It's Trump's clear goal to try to get as many auto assembly jobs out of other countries and into the U.S. as he can. And with those jobs, if he's, to the extent that he's successful, go the parts jobs. And that's a massive issue for Ontario going forward.
Yeah, and we've seen that, right? Especially with a lot of layoffs, a lot of changes in terms of production at certain facilities in Ontario auto plants throughout the year. I mean, this is a unique battleground when it comes to CUSMA and the year ahead.
That's right. There's 3,000 people at the Brampton plant that is Stellantis Chrysler, whose futures are very uncertain. There are a bunch of people in Oshawa who are still making pickup trucks, but their futures are somewhat uncertain as it's not clear what exactly production will look like in a tariff world. This is a totally different one than the one we're accustomed to.
Yeah. And I mean, when we zoom out and look at the impact of the tariff world, like you talk about, Andy, I mean, the red tape that this has created for small businesses across the country is phenomenal.
I was horrified just researching this segment at the amount of extra paperwork small businesses in particular have to do, because now they have to certify that they meet CUSMA. And it's not just as simple as just filling out a form. All of your components of the thing, we're talking about goods here, not services, all of the components have to be certified. And then when you put this thing together, you've got to recertify the whole thing. And that adds friction and costs, very tough on small businesses. Plus, we had that thing where the Americans got rid of the de minimis exemption, whereby small Canadian firms were shipping to U.S. customers. If the value of the shipment was below $800, they could get it into America duty-free. That's gone as well. So small businesses have been a victim here, I think, in particular.
Yeah, definitely. OK, so I want to talk more about CUSMA in a moment and the renegotiation that we have to look forward to in 2026, what that can mean. But first of all, we can't talk about 2025 tariffs and trade without talking about the number of ads that the Ontario government put out. And of course, the last one that was out later in the year, the Ronald Reagan ad, was very disruptive, you could say. Donald Trump did definitely take notice of that. Before we talk about it, we do have a quick clip of the ad for those who maybe didn't see it. You can hear a little bit of it now. Take a listen.
High tariffs inevitably lead to retaliation by foreign countries and the triggering of fierce trade wars. Then the worst happens.
So Premier Doug Ford standing by this, saying this was the best ad he's ever seen.
It was a smart concept. And it got under the skin of Ford. It was a brilliant idea.
It was a good, I mean, it's all about Ronald Reagan, one of Donald Trump's supposedly favorite presidents, talking about how tariffs hurt the U.S. economy. Do you think maybe it obviously made an impact with Donald Trump?
May have backfired, obviously, was Trump claimed that he was calling off the talks because of that ad.
Yeah.
But why did it get under the president's skin? Is because it was true. Because Ronald Reagan was mostly a free trader. And of course, that ad is taken from an address where he's trying to explain to the public why he's taken a trade action against Japan many, many years ago, but still believes in the principles of free trade. It was a real hot button.
Yeah. And the idea was to kind of target other Republican leaders throughout the country, get them thinking about it, and maybe go to the White House and talk a little bit more about whether this is the best idea forward. I'm not sure whether that worked or not, but it was definitely a moment this year in 2025 when we're talking about tariffs.
And people, I tried to track whether was there any case in which they distorted the former president's words, and I don't think they did. I mean, obviously, with any kind of clip like that, they took bits and pieces from here and there, but I think they fairly reflected what Reagan had said.
It was mostly in context, yeah. Okay, so looking ahead to 2026, CUSMA, and looking back on the year that just passed, we've got the renegotiation of CUSMA coming up in 2026, that free trade agreement between Canada, the U.S., and Mexico. But first of all, let's talk about, I'm not sure who wants to pick up on how important this free trade agreement was for Canada when it came to a buffer with a lot of industries against tariffs.
It was, really. I mean, we do have among the lowest tariffs of any country trying to get stuff into America now, apart from steel, aluminum and lumber, and autos have been hit to some extent. So CUSMA has been a major safety factor for Canada in this current trade disruption.
And I think to Andy's earlier point about there's a tremendous paperwork burden, especially on small and medium-sized businesses, but by and large, they went through that. And so more than 85% of what's shipped now from Canada to the U.S. does meet that compliance test. And that's really a big part of the reason why the Canadian economy held up reasonably well, certainly probably much better than most economists thought it would, back in March and April when the trade war was sort of really starting to heat up.
And it may turn out that Mr. Carney, the Prime Minister, has played this pretty well. I mean, it's always hard to know, but after talk of elbows up and our relationship with America is broken or certainly transformed, he then backed down. He dropped retaliatory tariffs. He backed down on the digital services tax. And that led to a fairly small tariff burden on Canada. I mean, it's hard to attribute exact cause and effect here, but it looks like he may have handled it well.
It's hard. Yeah, he's keeping things very quiet, a very small group around those negotiating tables when they were happening. So it's hard to know. But yeah, you can take hints from that. Okay, then let's talk about 2026. I mean, there's the renegotiation coming up. How important is this that we keep a lot of what the current free trade agreement has intact?
I mean, it's really vital. And of course, there are certain sectors, we've mentioned autos, but more broadly, the manufacturing sector, I think, is one of the most under the gun. I think one of the things to really look for is the Trump administration is being quite vague about what they want, and that's by design. For them, uncertainty, keeping it's part of the Trump playbook, keeping your opponents on their toes, but also, as long as there is this uncertainty, companies that want to invest will be more likely to say, well, I'll just invest in the U.S. because then I'm assured of access to that market. And the more that they can keep a cloud of uncertainty around what's going to happen to Canada and Mexico, the longer that goes on, the harder it is for those countries, our country, to draw investment.
It is going to be hard, obviously, for Canada to build markets around the world. This country's been talking about that for decades, diversifying trade. But America is so much the natural trade partner, if only because of geographical proximity.
Okay, we'll have to wait and see what happens there. Good conversation. Thanks, guys.
Thanks.
Thank you.
And stay with us. We'll be right back right after this.
Well, Canada's sovereignty has been facing pressure during U.S. President Trump's second term, leading Prime Minister Mark Carney to prioritize military investments. CTV's Judy Trin has more.
Canada's new government will rebuild, reinvest, and rearm the Canadian Armed Forces.
The Prime Minister's clarion call to defend against a superpower's imperialism.
What I'd like to see, Canada become our 51st state. We give them protection, military protection.
Donald Trump turned his threats into a trade war, pushing Mark Carney to turn the military into an economic shield.
I'm announcing today that Canada will achieve NATO's 2% of GDP target this year, half a decade ahead of schedule.
Carney's first budget invests nearly $82 billion in defense over the next 5 years. There's more money for recruiting, training, and equipment. Soldiers are getting raises and bonuses for serving overseas and deploying in the far north.
The priority is the defense of Canada and the Arctic. So we are investing both in terms of capabilities, but also in terms of planning and programming.
Climate change has made Canada's Arctic and its natural resources vulnerable to foreign intrusion by Russia and China. Better weapons are needed to patrol from the land, sea, and air. In the past, 75% of procurement dollars went to American companies. That's being reduced.
We're not going to be spending 75 cents of our dollar south. We'll be amortizing that money out in Canada where we can, and then spending it in other places where we have to.
The Defense Investment Agency, created in October, aims to ensure that Canadian companies benefit from big procurements, like the plan to replace a fleet of aging submarines. The Navy wants 12 conventional subs.
The reason we need submarines is very simple. It's the only technology in the Navy that guarantees that we control our waters.
There are two competing bids. The Prime Minister visited TKMS, the German-Norwegian conglomerate, in the summer. Then in the fall, Carney visited the South Korean rival, submerging himself in Hanwha's proposal.
I'll be back in 60 days.
The contract, which includes manufacturing and maintenance, could be worth more than $100 billion. The winning bidder is expected to share the rewards.
Buying Canadian, both in terms of steel and aluminum. So that's not a surprise. I think for both submarine manufacturers, they would be looking at that. Obviously, the question of servicing these vessels over time. I mean, remember, this is a long-term investment. We're talking 30, 40, maybe even 50 years.
While the submarine supplier will be chosen next year, the decision on fighter jets is still up in the air. Canada has already purchased 16 F-35s from the U.S. With Trump's tariffs, whether to buy more is being reviewed.
I don't believe that we've had enough jobs created and industrial benefits done out of the F-35.
Then there's the Swedish charm offensive. The King leading the charge to pitch the Gripen fighter and offering to build the Nordic jet in Canada.
The government's steps to diversify our defense and trading relationships are absolutely crucial, but need to be accelerated.
The military budget will continue to increase over the next decade. The Prime Minister, along with NATO allies, has committed to spending 5% of GDP on defense by 2035. That will equate to roughly $150 billion a year, the cost of defending Canada's sovereignty. Judy Trin, CTV News, Ottawa.
And coming up next, Chinese smartphone giant Xiaomi beat Apple. Now it's taking on Tesla. We'll dive in with a Bloomberg talk after this. Gold and silver are off today. You look at silver off by 7 1/4 right now. Gold off by 0.8. Of course, after making that recovery Tuesday, the metals, though, have seen exceptional volatility during this holiday trading period. The changes have prompted exchange operator CME to raise margin requirements twice. Now, on the upside, both remain on track for their best year since 1979. Demand has been strong amid mounting geopolitical risks and successive interest rate cuts by the U.S. Federal Reserve. Shares of Taiwan Semiconductor are edging higher today, up about 2.3 right now. That's after a report from Reuters that chip giant NVIDIA has approached the manufacturing company to ramp up production of its H200 AI chips. The move is in order to meet surging demand. Chinese tech companies have ordered more than 2 million H200 chips for 2026. TSMC is expected to start working on the chips in the second quarter of next year. Take a look at Vanda Pharmaceutical shares soaring up more than 32% after the U.S. Food and Drug Administration approved their treatment for motion sickness in adults. The approval marks a first-of-its-kind treatment in motion sickness in more than 4 decades. The medication has been licensed by Vanda from drug manufacturer Eli Lilly. Vanda expects to launch the treatment in the coming months. And taking a look at the markets, another down day for them right now. The TSX has been kind of waffling between red and green right now. It's up by 0.16. S&P 500 down 0.23. The NASDAQ about the same as we end the year with no Santa Claus rally. Well, Chinese smartphone giant Xiaomi succeeded where Apple failed by launching its own electric car. Now the tech company is betting big on EVs and setting its sights on Tesla. This Bloomberg doc dives deeper.
What tech giant has a connected ecosystem of products, a devoted fan base, and is constantly innovating? If you're in the US, you may say Apple, but in China, it's Xiaomi.
It's this consistent marketing to the younger consumers in China that has cultivated kind of a cult following.
For many consumers in China, Xiaomi is Apple, is Tesla, is Google.
Now, Xiaomi has managed what Apple failed to do: build a car.
全中国最火的车，小米与其。
Xiaomi shares have touched a record high after strong initial orders for its new $35,000 SUV.
Within 3 years, they managed to set up this very complicated supply chain in China and essentially churn out these incredibly popular cars.
Profits have jumped as customers rush to the company's latest offerings. But succeeding in the world's most crowded EV market isn't easy.
Competition is really fierce right now.
Growth will mean turning Xiaomi into a global brand. And this is no easy task when the world's biggest economy is effectively off limits because of trade barriers. Yet, Chinese companies are already tapping markets beyond the US. So, is Xiaomi on easy street, or will it be a bumpy road to success? Xiaomi is one of China's biggest smartphone and electronics companies.
Their phones are innovative, creative by design, but in the meantime, it's much cheaper than top-line competitors like Samsung and Apple. The quality of the phone may not be as good as iPhones, but if you look at the operating system, that's something that will get buyers.
大家晚上好。
The company's image is inseparable from its founder. Think Apple and Steve Jobs. That's how China sees Xiaomi and its CEO, Lei Jun.
Lei Jun is a big reason for why the company has been so successful.
Xiaomi's first product was for the Android operating system, but it quickly moved on. By 2014, it was China's most popular smartphone. Xiaomi's products tap directly into the modern consumer's desire for connectivity.
They are selling lots of things.
Toothbrushes, scooters, cat feeders, watches.
And even mattress. I mean, what kind of tech company sells mattress?
The goal that Xiaomi is trying to achieve is to seamlessly integrate Xiaomi's products into almost every corner of your life.
The EV project is to fill in that void for Xiaomi so that it can build a fuller ecosystem for its users.
But there was another reason. In 2021, the company's growth hit a roadblock.
The biggest reason for Xiaomi to enter into EVs was because of US sanctions. And that actually put Xiaomi management into a panic because smartphones was still quite a big chunk of their revenue at that time.
What shall we do?
The board was actually asking Lei Jun, what are you going to do if you can't sell smartphones anymore? So when it was first brought up, Lei Jun was struggling a lot.
Lei Jun wrestled with the idea for good reason.
Many people say EVs are actually smartphones with wheels, but it's much complicated than that.
If you're making a smartphone, I think the number of components is probably over 1,000 or 2,000 or so components. But if you're making a car, that number jumps to tens of thousands of components and a very extensive supply chain.
Lei Jun admitted that he was not someone who knew about EV that well. And then you have to bring in talents, right? The best way to do that is to scoop from other companies.
So Lei Jun set about wooing the best talent from across China's EV industry.
Xiaomi's headhunters actually reached out and he basically offered them the salary that they cannot say no.
Geely is probably one of the best examples because their former director of their research institute decided to go over to Lei Jun's investment fund. We also know that executives from BMW, from other Chinese automakers such as SAIC and Wuling have also joined Xiaomi.
With talent in hand, Xiaomi threw itself into all parts of the EV supply chain, investing over $1.6 billion into more than 100 companies, and eventually constructing its own factory in Beijing.
I don't think we've seen anything like that in the auto industry, at least definitely for the China market.
In 2024, Xiaomi launched its first car, the SU7. All of this has sent Xiaomi's stock surging, faster than its European counterparts.
Xiaomi has always denied this, but just looking at Xiaomi's first EV, the SU7 sedan, a lot of people would say that it resembles a Porsche Taycan.
They're trying to learn from the best, and in the meantime, the boundary between learning and copycatting, I don't think it's that clear.
And Xiaomi's been taking notes on mistakes as well, avoiding issues which slowed its competitors down.
苹果10年都干不成，凭啥你们3年能干成？其实这个产业都已经很成熟，我觉得3年干成呢，就是一个标准的时间啊。
So, how did a company largely unknown outside of China manage to do what Apple couldn't?
Apple and Xiaomi probably were reaching for different goals. Apple was really looking to disrupt the entire automotive industry with something like an entirely autonomous car that required no human assistance. While Xiaomi took a more grounded approach, it's not a completely new disruptive product on the market.
On top of this, Xiaomi has proved to be very efficient at scaling up. It took 230 days for the EV maker to pump out its first 100,000 units, while for some of its Chinese competitors, this took far longer. And it's a good thing too, because their cars are selling fast. Its price tag is part of the reason why. In China, the starting price for Xiaomi's SU7 is just over $30,000, and its follow-up vehicle, the YU7, is around $35,000. This makes them competitive alternatives to Tesla's Model 3 and Model Y. The incredible pace of Xiaomi's EV development also shows how unique China's market is.
Through the past decade, the Chinese government has invested heavily into building out this charging network, as well as a supply chain that goes everything from batteries to technology such as LiDARs. So all of these state support has meant that there's a very mature and sophisticated supply chain to help get a new brand off the ground.
In 2024, just over 64% of all passenger EV sales were in China, and China has around 140 EV manufacturers. But when looking at a list of the country's best-selling cars, Xiaomi is a small player.
It's not bad for a company that has only 3 years of experience making EVs, but if you talk about BYD or Tesla, they are on million level.
Xiaomi set an ambitious goal to become one of the world's top 5 car makers within the next 15 to 20 years. To make that happen, Xiaomi needs to find customers outside of China, but there are a lot of hurdles in the way.
Similar to other Chinese automakers, Xiaomi is going to face a lot of geopolitical uncertainties as it expands globally. You've got all of these trade barriers that regions such as the EU, the US, Canada, Turkey, they have all introduced tariffs to try to stave off this wave of Chinese EV expansion.
The US has a 100% tariff on Chinese EVs, effectively locking Xiaomi out.
It's very, very difficult for a Chinese brand to penetrate that market.
The industry dominant player right now is BYD, and you've also got the industry pioneer Tesla that is actually suffering a slump in sales. So it's very hard to say how things will turn out within the next decade.
Coming up, we are exploring the Canadian Quantum Champions program with our next guest. That's after the break. Lisa Lambert joins us. Twenty 2025 was the International Year of Quantum Science and Technology, according to the UN. And this year, Canada made its own quantum leap at the G7 leaders' agenda by moving quantum from science to strategic infrastructure. It also unveiled the Canadian Quantum Champions program. Here to talk about that quantum leap from awareness and research leadership to execution and scale is Lisa Lambert, CEO of Quantum Industry Canada. Lisa, thank you very much for joining us today.
Thanks for having me today, Roger.
Let's talk a little bit about the program itself, what its goals are, and where we're at with it.
Yeah, the Canadian Quantum Champions program, or CQCP, is really about pushing quantum toward reliability, scale, and broader real-world use. So this isn't a research program. It's really geared towards industrialization and commercialization. And it's focusing on a specific type of quantum computing, what we call fault-tolerant general-purpose quantum computing, and developing those capabilities here in Canada. And that's really important, as that's what's going to take us beyond what we're doing with quantum computing today, which is some of these more short, noise-constrained operations. We're focusing on more narrow problem types and being able to achieve broader use and go after some really big problems in fields like chemistry, some broader applications in finance, in materials development, in drug discovery, and a lot of those really exciting areas that have people really lit up about the field.
Now, a lot of people are trying to wrap their heads around AI. Then we throw in quantum computing, and everybody just goes, so what can quantum computing do? What could it do for industries that like you just mentioned?
Yeah, I think a helpful way to think about quantum computers as is quantum computers as special purpose calculators, and they're good at specific types of problems. And some of the problems that quantum computers will be really good at, one is simulating nature. So we're able to look at chemistry, which is very much a quantum playground, and able to simulate the chemistry directly, for example, to be able to look at new things with drug discovery, to be able to significantly shorten timelines for drug development, to be able to develop next era batteries and everything that has a chemical basis to it, new catalysts for fertilizers, a whole range that way. Another area where quantum computers have a lot of strength for them is around optimization, or really complex challenge in that space. This has applications from logistics right through to the finance sector, has tons of really interesting optimization challenges. Another area is machine learning. So this has applications for AI as well, and being able to do some interesting things that way, shrink some model sizes down and accelerate some of the computation that'll be involved. So that's another area being actively explored with quantum computing. And another area where quantum computers show a lot of promise and are also driving a bit of fear is with cryptography, and being able to break through the cryptography we use today to secure our digital infrastructure. So the good news on that front is there are solutions, and there are standardized solutions that are out there, and opportunities for people to move towards that new type of cryptography, which is an active effort being pursued globally right now.
Now, there's 4 different companies were awarded money. There's so many other Canadian companies that are involved in this industry. They're taking 4 different approaches. How important is it that Canada look at different options to try and find a solution to this, or advance it, I should say? And how important is Canada to be at the forefront of this?
It's a really great question. Right now with quantum computers, we haven't yet landed on one single approach to build a quantum computer. And we may not. There may be different ways to build them that have different strengths and features for them. So CQCP, this program, is open to different types of technical approaches. And here in Canada, with our strength in quantum technologies, we do have a number of different companies that are approaching different architectures for it. So this program is approaching that, but also introducing milestones and independent benchmarking with a focus of how do we accelerate these technologies forward? How do we build these general purpose fault-tolerant quantum computers with clear pathways towards industrial relevance?
And what are some of the breakthroughs we should look for coming up in 2026?
Yeah, I think what we're going to see in 2026, I would expect, is a lot of hard work being done in the engineering side of it. So right now we do have quantum computers today. They're smaller systems. It's going to be some research and really an engineering challenge to be able to scale these up. So seeing some consistent progress towards that is something that I'm really looking forward to and anticipate in 2026. And I think we'll also see start to see some really exciting things being done in these systems, and being able to roll them out a little bit more, and working on some of the applications in different target areas, whether that being chemistry or materials, and starting to see some really promising demonstrations of what these can do.
Okay, and we're almost out of time, about 20, 30 seconds. How does Canada compare to the rest of the world and the companies that are here? Are we at the front?
We're well placed for this. Canada recognized the strategic opportunity in quantum decades ago, and we actually started commercializing in this space before most of our allies, adversaries alike, started to realize that there was something really interesting happening in quantum. So we have real strengths across the full quantum stack, not just in quantum computing, but in sensing and communications, in networking, and the enabling technologies that underpin these. So we've got a really good basis here, and we've got a really vibrant research, but also a really, really vibrant industry that's emerging, and it's an area where we can really play to win.
Okay, we're going to have to wrap it up there, but Lisa, thank you very much for joining us. All the best in 2026.
You too. Thanks so much, Roger.
Lisa Lambert is the CEO of Quantum Industry Canada. Coming up, we'll continue our look back on 2025. Well, 2025 for Canadian sports fans was a year of historic wins, deep playoff runs, and some national pride. John Benavalli-Rao recaps this memorable year.
Whether it was on the ice or the baseball diamond, this year's biggest games all seem to involve a Canadian team taking on an American rival in a year where geopolitics added to the drama. And nowhere was that more on display than at the Four Nations Cup in February. Can you see? Ahead of a Canada-US game, fans booed the Star-Spangled Banner. It all came amid Donald Trump's tariff threats and involving teams that are longtime rivals.
We're going to drop the gloves right away.
A fight broke out moments after the puck was dropped, and then another and another. 3 fights in the first 9 seconds of the game, which Team USA would go on to win. The two teams facing off again in the final. And in overtime, Team Canada coming out on top. A win celebrated across the country.
They were always going to get it done. I had no doubt in my mind.
But just a few months later, another Canadian team would try for an even bigger feat to bring the Stanley Cup back to Canada for the first time since 1993. The Oilers besting the Golden Knights to go to the Western Conference Finals. And then advancing to play the Florida Panthers for the Cup for the second year in a row. Fans around the nation getting behind them.
Out in front, score!
The Oilers winning Game 1, but Florida tied it up in double overtime in Game 2. Stressed out Oilers fans posting images of their high heart rates while watching. And in the end, the Oilers lost the series in Game 6. The Panthers, Stanley Cup champs once again.
Obviously, we're disappointed with the result. It's not what we wanted.
Another Canadian team that started to get attention around that time was the Blue Jays, who'd finished dead last in their division the year before, but started to rack up the wins, and by July were on top of the American League East.
And a drive to deep left field.
And on the last day of the regular season, winning their division. Something the Jays hadn't done in a decade. In the playoffs, they first faced the Yankees. The Jays winning in 4 and spawning this viral moment.
The Yankees lose!
Up next, the Mariners. A battle that saw thousands of Canadians cross the border to cheer on the Jays in Seattle, where leadoff batter George Springer was hit by a pitch in Game 5. As he hobbled off the field, some Mariners fans were heard cheering.
And a swing and a fly ball.
But then in Game 7, the Jays trailing 3-1, it was Springer who crushed a 3-run homer, the Springer Dinger, that led the Jays to the World Series for the first time since 1993. This, the reaction on the streets of Toronto.
This is absolutely monumental. We needed this, Canada. We needed this.
The Jays, seen as the David to the Goliath LA Dodgers, who were seeking back-to-back championships with the help of superstar Shohei Ohtani, a series that had it all.
To the bottom of the 15th.
From a nearly 7-hour game that lasted a whopping 18 innings.
It's grounded to second.
To an epic finale, Game 7, considered one of the best baseball games of all time, that went 11 innings, and saw the Jays several times come within inches of winning it all. But in the end, the Dodgers came out on top. For Jays fans, a crushing defeat, but hoping the team will make a return to the World Series in 2026. John Benavalli-Rao, CTV News, Toronto.
Well, Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. And that wraps up this edition of The Open. The morning markets are up next. Have a great day.